Hi, welcome to this short talk about accounting incentives. Today I'm going to talk about how News Corporation, an international corporation with operations in Australia, managed to recognise internally generated goodwill and why they did this. This is based on an article in the Sydney Morning Herald in early 2015, utilising some research done by Geoffrey Knapp at the University of New South Wales. Now, essentially, what News Corporation did was recognise internally generated goodwill when we know that IAS 38 prohibits this. So a company under IAS 38 paragraph 48 is explicitly prohibited from recognising goodwill, internally generated goodwill, as an asset. And the logic is the logic that we are comfortable with. The problem is you cannot reliably, objectively measure this thing. Okay, so why would you want to recognise internally generated goodwill? Pretty obvious. The usual suspects are risk measures on the balance sheet. You want your balance sheet to look better, and pumping up assets is one way of doing that. Or what News Corporation actually did, the main purpose was international tax avoidance. So let's just understand what they did. News Corporation basically had a holding company in Australia that was running the Australian operations. What they did was they interposed a new company. The new company was called News Australia Holdings, to acquire the Australian operations of News Corp from News Corp. Mind you, this new company, News Australia Holdings, was itself owned by News Corp. It was set up solely for the purpose of undertaking this transaction. So the new company was capitalised by News Corp. Essentially, it started as a $2 company. They acquired the old Australian company at a premium. So what happened there? Basically, the new company gave News Corp a lot more shares in itself, and in exchange, News Corp gave it the old Australian holding company. So by giving some shares to News Corp, News Australia Holdings acquired the Australian operations of News Corp. Now, you know that when you acquire a company, you measure its assets at fair value, and if you're paying more than the fair value of the identifiable assets, the difference by definition must be goodwill. And surprise, surprise, guess what? The amount that News Corporation sold this company to News Australia Holdings for was greater than the present value of the identifiable assets. What's the difference? Well, the difference is usually goodwill. So this goodwill was recognised. Now, what's the advantage of this? The advantage of this is that News Corporation, after this transaction, had a larger Australian investment than it did before, because this goodwill was suddenly recognised. Now, if you've got more capital, what have you done on your balance sheet? Your balance sheet owner's equity section is either share capital or it's retained earnings. What you've effectively done here is you've increased the size of this balance sheet. And then, a few years later, returned capital from the News Australia Holdings, new company, to News Corporation in New York, but the capital was returned out of share capital. It wasn't a dividend payment. And of course, a return of capital is non-taxable, whereas a dividend is subject to Australian withholding tax. What's the effect? Well, in this particular case, News Corporation essentially avoided $1,000 million in Australian withholding tax on dividends. So let's just have one more look at that. Here's the article from Sydney Morning Herald describes it, and I've talked you through that. Let's have a look at what that looked like in pictures. So News Corporation held an investment in the old Australian holding company, the old Australian operations. That was when we started, step one. Step two, News Corporation set up a shell company, News Australia Holdings, essentially a $2 company, that had no assets, and simply News Corporation had some shares in it. Or it might have had $2 worth of assets, who knows. That's step two. Now in step three, what News Corporation did was it contracted with News Australia Holdings Limited, and News Australia Holdings Limited gave News Corp some shares. So basically, News Corp invested additionally in News Australia Holdings, right? In exchange for that, it got some shares. How did it invest? Did it put in cash? No, it didn't. It put in the old Australian operations. So the old Australian company, Company 2 here, has moved across from being owned by News Corp to being owned by News Australia Holdings. So essentially what happened in this transaction was News Corporation gave the old Australian business to News Australia Holdings, and in exchange, News Australia Holdings gave News Corp some shares in itself. Oh, and as part of that transaction, when you measured everything at fair value, it turned out that the old Australian operations are now a little bit bigger than they were before. So you've recognised some goodwill on an internal transaction.